Hi, this is Barry Haimo. Thanks for tuning in again to another dose of bite-sized bits of knowledge where we give you meaningful information in a short amount of time. Today we're going to talk about estate planning as it relates to taxes. The next video we're going to get into a little bit more granular on income taxes. But for today we're going to talk about estate planning and taxes in general. So, what taxes are relevant to estate planning? Number one, you have your estate tax and gift tax. Right now, the threshold to be subject to that tax is $11.6 million or so per spouse. Per spouse. So if you're married, you can double it. What that means in English is that if you have $23 million, you really don't have to worry about estate planning. 23 million or less, which translates to pretty much being 99% of the people don't have to worry about it. However, it's a political figure. It changes. 20 years ago, it was $1 million. Anybody with over $1 million was subject to this very adverse estate tax, which can be as high as 40%. It's even higher than that before. So it was $1 million, it was 2, and 3.5, then 5, then it went away for a year, and it came back, and then it went doubled, and now it's 11 and change. We just borrowed $2 trillion in debt. We need the money. It seems to me inevitable that they're going to lower that threshold to pick up more people to be subject to estate tax. So do not get too cozy with your estate tax exemption. Your gift taxes, it's a unified credit, meaning estate and gift taxes are unified. So if you give somebody $1 million in cash, it just eats up some of your credit. And so you have less credit later unless you pay your taxes now, which nobody ever will do. So that's estate and gift taxes. There's also something called generation skipping transfer taxes, which is a fancy way of saying people got cute and started to try to bypass, excuse me, the estate and gift tax by giving it to their grandkids so they would skip a generation. So that generation skipping process was picked up by the IRS. Excuse me. This is not a placement ad for Corksicle. So that generation skipping ploy got picked up by the Treasury, and they came up with the tax called the generation skipping transfer tax, which basically says you're going to get taxed if you do that. They got to get their money at the end of a generation, so you can't skip it. That's included in the estate and gift tax planning. So just kind of conceptually put those together aside. Then there's of course there's real estate taxes, which is unavoidable. But there's also opportunities there too. And then income taxes. Income taxes are really where practitioners are focusing their attention now when it comes to estate planning. We're talking about shifting income taxes now during life, and we're also talking about, and more so, talking about minimizing, if not eliminating, the taxes that your beneficiaries will pay. Your beneficiaries. You gift your kids money, they're going to pay taxes on it, some way or somehow, depending on what it is. A lot of times people say, oh, we can accomplish a probate avoidance technique or a guardianship avoidance technique by putting people on title during life. We get it all the time. It creates so many more problems that are unintended, like gift taxes, like liability exposure and income taxes. It's a bad move. But we weren't consulted first, so we just give them the bad news again, and we can tell them they can help them fix it. So again, estate planning is very much mindful of taxes. You don't have to be rich to worry about it. It's going to affect you at some point. It's definitely going to affect your beneficiaries at some point. So I would encourage you to make sure that is part of your consideration. Thank you for stopping by, and stay tuned for more.